Good afternoon, everybody, and welcome to this edition of our weekly think tank for Monday, 25 Jan. My name is Carl Capilingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you for our weekly look at the week that was and an investigation of the week that will be. All of that and more after we talk about the Think Markets difference $8 flat rate trades, your own holder identification number, unlimited phone support, and no hidden platform or subscription fees. 4 fantastic reasons to choose us for your next ASX share trade, but let me give you 10 more if you switch over to us before January 31. The first 10 trades are on us. So get to the website, download the Think Trader app, and open an account. The agenda for today's presentation is to have a look at those key market moves from during the week. We'll see what's going on with the global COVID situation, check out some of the big economic data announcements from the week, have a look at what the brokers were saying, see where the value lies in the Australian market, and some technical analysis before we finish off by looking at the week ahead. First, a quick look to the week that was, and a pretty good week for the ASX 200, up 1.3%. And I do note on my screen over here to the left that it is tracking pretty well, up about 0.3%, trading near the highs of the session today. And overall, the technical picture is very constructive, as we'll see in just a second when we look at the chart. But just noting the best performing sectors from last week: information technology up 5%. It's not often you see a sector up 5% a week, but that was a very, very strong performance as we saw those buy now, pay later stocks surging. Afterpay, Zip in particular. I reported last week that one of their competitors in the US listed on the NASDAQ exchange, and the valuation that US investors were apportioning to that stock meant that investors over here, if they chose to, could pay a higher multiple, and so we've seen the prices go up on the back of that. The other very, very strong sector is consumer discretionary, and we have talked many times in these sessions about that redirection of spending away from even domestic but mainly overseas travel towards buying things that make us look nice, or buying things that make our houses look nice as well, or fixing up our cars. Apart from that, healthcare did pretty well, bouncing back up 3.3% as Citigroup upgraded CSL, Cochlear and Ramsay Healthcare. Now, those stocks had been hit pretty hard. More recently, you can see over the last month down about 2.4% as the Australian dollar was rising, and as COVID cases, or on a resurgence, I should say, of COVID cases in Europe and the US. So good to see those stocks bouncing back. Otherwise, telecommunications and staples doing pretty well also. Energy down a little bit, as we'll see in a second. Energy prices just came off after a pretty good run over the last few weeks. Okay, we talked about the technical situation, and this is where we check it out, the chart of the ASX 200, and we have broken through what for me is a pretty key range here, through 6766 down to 6585. And actually this Wednesday, we're going to be holding a Think Learning webinar on an introduction to technical analysis, and we'll talk about exactly these sorts of things. So once you break out of this consolidation pattern, you tend to move in the direction you're moving pre-breakout. The probability is skewed towards that. But either way, when the breakout occurs, the way you measure the move is using what happened before, and then we go from the bottom and we can project up. And that would take us past those February 20 highs of 7197 and into some pretty rare areas. So that would be nice if we did that. In terms of timing, it probably could happen around about the end of February or into March is a possibility. And if we're heading the other way, just for completeness here, if you're heading the other way and you have a range like this, and you were to break down out of that range, you would measure this move through here. But it is possible that you break the other way through the range. So for example, if you were to break through here, and then you'd be targeting the top of that previous move, wherever that was. But as I said, get on to the home page, select the market analysis tab, scroll down and hit the webinars tab, and then you can register for that webinar on Wednesday. Okay, wrapping up everything else that happened during the week on all of the other markets. The Nikkei in Japan was up 0.4%, Shanghai Composite up 1%, Hang Seng up 3%. It was a fairly broad-based move higher in Asia for the week. In the US, it was also a stronger week. The Dow Jones was relatively flat, but the broader market of the S&P 500, Nasdaq Composite and Russell 2000, not on screen, also nicely higher. In particular, those technology stocks up 3.3%. And it was good to see the volatility index. That's investors' nerves coming down by nearly 6%. In Europe, it was a bit of a mixed bag. We saw the UK down 0.6, the German DAX up 0.6, and the French CAC down 0.93. Base metals were generally stronger. We saw good gains in tin, in zinc, in lead, and to a lesser extent aluminium and copper. Only steel missed out there, and iron ore was down a touch as well. Good to see precious metals bouncing back as the US dollar index weakened. That's that figure there, down 0.6%, which allowed the Australian dollar to rally slightly. And we did discuss the weakness in the energy sector locally because we saw a small pullback in energy prices, but they're still well up from where they were 1 month ago. Bond yields were pretty flat. Having a look at where we are this crisis compared to the last crisis, and it's a little bit of fun. We have each Monday in the think tank, and the old saying is that history doesn't repeat, but it sure does rhyme, and it's certainly rhyming here with the light blue line, what's happened in this crisis. So this is the COVID crisis, and the orange line is the GFC, which stands for Global Financial Crisis. And I guess obviously when there is a major negative impact on the market, the policy responses tend to be similar, and I guess in some ways the rallies tend to be similar, but so far so good based upon that chart. Not so good as the COVID situation, but at least it's getting better. We can see a downtrend in some of those curves in Europe and the US, but still at uncomfortably high numbers of cases on a 1 week rolling basis, 176,000 and over for the US and over 200,000 for Europe. But the trends are starting to turn down in a number of those key economies. Having a look at the economic data from the week, we had some data out for Australia. The Westpac Melbourne Consumer Sentiment Survey ticking down. Now, this is the result for January, and retail sales ticking down for January. It's not often we see that because obviously coming into the end of the year, we have Christmas and then the post-Christmas sales. Let's talk about the Consumer Sentiment Survey first. So that was adversely impacted by the fact that in December we had those COVID clusters popping up in Sydney and a bit later on in Melbourne and in Queensland as well. Now the good news is all of those are in hand, so this downtick we saw in December will probably back out when we get January's numbers out next month. And retail sales look partially impacted by that, by snap lockdowns and inability to travel across borders, border restrictions going back up, but also based upon just a monthly comparison, given that November was so strong. So we had both the Black Friday and Cyber Monday sales events happening in November, which pushes up the November level. So when you get the December reading, it looks a little bit weaker than perhaps what we were expecting. But I wouldn't read anything too nasty into those figures just yet. A little bit more concerning was the fact that jobs growth is continuing on a downtrend here. So certainly the Reserve Bank and the federal government will be watching that. We still did create 50,000 jobs on a seasonally adjusted basis in December. That was in line with expectations, I would say, though, but certainly less than the previous 90,000 from November. The unemployment rate continued to fall and the participation rate edged higher. In China, we had what we traditionally call, as analysts, the data dump. So once a month you get a bunch of data from China coming out at once. So we had the fixed asset investment, industrial production, and a couple on the next page coming out. This is still trending in the right direction on fixed asset investment. We're still seeing nice trends here on industrial production. In retail sales, a small move down, but overall I think the trend is still firm there, as is the trend on unemployment, and certainly also on GDP that is heading in the right direction. So I think, all in all, that data painting a very strong picture for the Chinese economy, and of course that will help our economy, assuming there are no major fractures going forward on the trade front. And that is somewhat of an assumption, isn't it? And it should be good for iron ore prices as well. Okay, having a look at US data, we saw a continued weakening in the US National Association of Home Builders Index, but it is coming off record highs, so they are levels never seen before. And part of the reason for the overall confidence is the fact that the building sector over there is really booming. So you're looking at sales of existing homes way up, but also permits and housing starts. So this is construction activity. It means jobs and it means growth for the US economy, and that's a positive. Slight positive on the weekly unemployment claims, down to 900,000 from 926 previously, a little bit better than expected, but still way above what we'd like to see. So they were sort of averaging around about 200,000 pre-crisis. So you can see that we are still way above in terms of the dislocation within the US economy, and there are still around 5 million Americans claiming for weekly unemployment benefits, and that is well up again. It's about 3 or 4 times what it was pre-crisis. We did see some slight upward movement on the Purchasing Managers Index also at the end of the week. Have a look at some of the broker moves during the week, or at least certainly this one for Super Retail Group, ticker code SUL. It's an auto parts retailer, also a wholesaler as well. And you know Super Cheap Auto, you've probably driven past them many times. The company's doing extremely well at the moment. They are riding this boom of overseas travel spending redirection back into autos. We're making our cars last a little bit longer because, there is some uncertainty out there, but also we want to avoid public transport as well, given the COVID crisis. So used car sales are way up and spending on our cars is also up. They said to the market that they are expecting their sales for the first half of 2021 to triple. So that is an extraordinary increase in sales. Looking at what the brokers had to say about that trading update, Citigroup raised their price target from 13.10 to 14, retained their buy rating. They predicted the retailer will continue to outperform its peers over the next 6 months and increase their FY22 earnings expectations. Credit Suisse also has a very good rating on this one, outperform. They also increased their price target. They remain confident that sales momentum can be maintained into FY22. So we're looking forward now. They said that the valuation is attractive and continued re-ratings are likely. Macquarie Group raised their price target. They're a little bit more circumspect with a neutral rating, but they did say that it was a strong update. And very important here, noting that some of the gains are going to be permanent. So there are, a few critics out there of this sector saying that, well, when everything gets back to normal, there's going to be a bit of a bust in sales. And if Macquarie come out saying, look, some of that spending is going to be permanent. And they noted also that the margin improvement is pleasing. So less discounting going on at retailers at the moment because we're so keen to spend. Morgan Stanley came out a couple of times during the week to talk about this one, hence the 2 ratings there. We've just got a quick note on it and then a more detailed note the day after. But initial impressions were strong and better than expected. And then they obviously had a more detailed note where they said they were very impressed by first half sales performance. It was significantly better than what they were expecting. Cash flow was a highlight. Makes capital management increasingly likely, so the ability to pay increased dividends or special dividends or share buybacks, and they upped their earnings expectations significantly by 40% and 24% for FY21 and 22 respectively. UBS has a buy rating on the stock, also increased their price target. They said it was a solid first half sales performance and tailwinds remain. The group is well placed to take advantage. Margin improvement very impressive. And if we look at overall what the brokers are saying about the stock, we've got 2 strong buys, 6 buys, 3 holds, no sells and no strong sells. So very positive there. The mean target for the company is around about that $13 mark, so offering a little bit of upside from here, but with a high estimate of $14.80. In terms of the valuation for the stock, so that's what the brokers are thinking about it. Well, what do I think about it? When I analyse the stock, I like to do 2 things. I like to find the right stock at the right price and at the right time. In terms of whether this is the right stock, I think so. It is a very well managed company. They've got, as we've discussed here, fantastic tailwinds behind them. Some of it will be temporary, of course, yes, no doubt, but some of it will be structural and will be permanent, given the tendency to move back to running your own car instead of public transport. I think that will persist for at least a couple of years yet. So that's why I think it's the right stock. Is it at the right price? Well, the stock is trading at a price to earnings ratio of 10 times, and that compares to the market's price to earnings ratio of about 20. So it's twice as good value as the average stock on the ASX. In terms of its growth rate, and we can measure that using the price to earnings growth multiple here at 0.72. Now, typically anything below 1 is a good rating, and 0.72 is a very, very good rating. So not only is it cheap, it's continuing to grow its earnings. Its dividend yield is fantastic at 6.2%. Consider what you're getting in your term deposit at the moment. Other valuation metrics, we can look at enterprise value to revenue. So this is the value of the company compared to the sales it's making. And that is extraordinary at 1.05, probably putting it in about the top 2% of all companies on the ASX. And your return on investment capital, that measures management's ability to squeeze the proverbial blood out of the stone at 24.77% is excellent as well. So right company, right price. Is it the right time? Well, looking at the chart now, that gives me the timing, and it is in a very well-established long-term uptrend, so that's a big tick. It's in a short-term uptrend, that's a big tick. We have high peaks and troughs, that's a big tick, and it's pulling back into a support zone, and that's a big tick as well, and it's starting to bounce off that, so that would make it a buy for me as well. So the brokers are a buy, I'm a buy, make of that what you will. Having a look at the valuation of the ASX 200, we discussed yesterday it's about 20. In fact, it's 19.97. That's moving a little higher because it's the orange line, a little higher over the last week or so, but still a little bit cheaper than the rest of the world at 20.88. Having said that, 20 is kind of that borderline between something being good value and being expensive. So it's certainly elevated compared to what we used to. Typically, pre-crisis, there you go. It's about sort of 15, and it could be a while until we get back down there, until the E's catch up to where the P's are. The P's obviously bounced very well. I'm talking about price because of the expectations of stimulus to come, and we need earnings now to catch up and make that P look valuable. In terms of the individual sectors, the cheapest sector at the moment, in terms of price earnings ratio, remains the materials sector. So we're looking at a P of 13.6. Again, compare that to the market P of about 20. In the financials, there's a little bit of value at 16.5. Property at 17. And then I would say the rest are probably above where the market is. Information technology, we know that's a high-flying sector. It was up 5% this week. That price earnings ratio is very high at 62.5 and rising. In terms of the technical analysis, and here we're looking at how many stocks are participating in this rally over short, medium and long-term time horizons. Of course, the more stocks that are participating, the more positive it is for the market. We say that the market breadth is greater. We've got a really broad-based rally. So the rally isn't relying on just one or two or a handful of small, large capitalisation stocks. It is broadening out to the whole market, which again is a reflection. Don't forget the stock market is a reflection of the local economy. So if the market is very broad, it's predicting strength in the broader economy as well. And given that it's not reliant on a few stocks, if those stocks tend to come down for whatever reason, there's still plenty of other strength in the market. So where are we in that regard? Well, this is the orange is the current level, and we've come up from last week. So we've moved higher from last week in the short-term moving averages. So these are the periods of the moving average. At 5 periods, that would be 1 week. You're getting out to 1 month here. And then obviously multiples of 21, because there are 21 trading days in a month, out to 1 year here. So it's quite a flat curve, which is very good as well. So we've got stocks in uptrends over the whole spectrum of that curve, and we've got about 60% of stocks in the ASX 300 that are above those curves. Well, how does that compare to the best and the worst? Well, the best would be, that is about 58% of stocks. 60% up here was the best, so that is the Feb 20 high is the green line. So there's a record high, and we are just below it in some of the shorter term averages, but very encouraging above it on most of the other averages. And look, a little bit down from where we were a month ago, because that was when the market made that just pre-Christmas high, but overall still well ahead of where we were at the bottom of that COVID-inspired bear market. So good to see us tracking along pretty well there. Okay, we'll wrap up today's session by looking at the upcoming week in data. And on Tuesday, we're going to get some inflation data in the form of the Consumer Price Index. That's pretty much it for the Australian week, or at least in terms of importance. Looking to the rest of the world, fairly quiet week. We do have a Federal Reserve interest rate announcement, but we're not expecting any major fireworks there. We do get durable goods orders. Actually, I do like to look at those. They're very important. So durable good is something that tends to last sort of more than 3 years. It tends to be a big ticket item, and we don't tend to make those purchases unless we're very confident about our situation going forward. So we say this is a very forward-looking indicator. It gives us an idea of what the economy is going to be doing in 6 to 12 months' time, and it reaches across all levels of the economy. So durable goods purchased by mums and dads, businesses, governments, the military, and the like. Then we'll have advanced GDP coming out on Thursday in the US, and finishing off the week with personal income and spending, and they are watched very closely by the Federal Reserve in the US for setting interest rates. That's it for us today. If you'd like to catch all of our other market news and research updates, head to this link here. If you're going via the homepage, it's in the market analysis section, as is the link to get to the webinars, which are down here. You do need to register for those webinars. First, as I mentioned, on Wednesday, we'll have our Think Learning session on Introduction to Technical Analysis, and I'll give you the ins and outs and how to read a chart. The week after that, we'll have the Ask the Experts session, where you get to tune in, and for half an hour, I'll analyse any stock that you're interested in. Bring your portfolio along, and we'll have a look at it from a fundamental and technical perspective. And why not also register for our Think Learning session on Feb 10th for how to create an investment plan. The disclaimer before I leave you, certainly have a good read of this information. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So before acting upon any of the general advice discussed here, please give us a call or consult the website for further details. That's it for me today. I'll be back on Wednesday, of course, with Introduction to Technical Analysis. All the best of your trading. Until we catch up again, bye-bye for now.